So good afternoon and thank you, everybody. We're at the top of the hour, 1 o'clock. Thank you for joining us for the BWAWomens Month Masterclasses. We are in the lunchtime session. We've had a bit of a whirlwind of a challenge of the afternoon, but we're moving fast into the afternoon. And this afternoon, we're going to be joined by Sivenathi, who's the Chief Operations Officer, Chief Financial Officer, apologies, at SM Tax. And she'll be talking to us around financial forecasting. This session is going to be carried live on womensmonth.co.za. Our team is fast making sure that the link is working on track. You're welcome to also join this particular webinar session on Zoom. The Zoom details are listed above. And you're also welcome to send us messages via Twitter using the hashtag BWAWomens Month. Without much ado, Sivenathi, you're welcome to share your screen so that you can take over from me here, and then you can continue the session for the next 90 minutes. Just as a reminder to everybody tuning in to this session, that these sessions are 90 minutes, are delivered in English, and Sivenathi will kind of talk through for the next 90 minutes. For everybody joining us on the webinar using Zoom, you are welcome to interact and engage with the facilitator. We've had a great, amazing morning starting earlier with Lisa from Amazi talking to us about, again, building a visionary kind of forward-thinking plan. And then we had Ilona from Bizpreneur talking about legacy and how women can build their legacy. We're now shifting gears this afternoon, getting a little bit more serious into our finance. Siva, are you okay on that side? Are you able to share your screen?
Perfect, great. Let me do so. Just 1 second.
Great. Thanks to everybody who's joining the call this afternoon. You are welcome to, there we go. There you're sharing the screen.
Perfect.
You can take over from here and I'll go on mute and I'll make sure that we host the session. I'm joined as well by Nathaniel here from MolaWeb, just making sure that the technical side of things are working out as well. So again, for the participants joining us on the call, feel free to use the chat box or the Q&A section. There will be about 15 minutes of Q&A later on, but again, depending on how well we do, I know we are running a bit late in time, but over to you, Sive.
Great. Thanks, Visa. And I think maybe before I go into it, I would really welcome any kind of questions along as I chat along. And I'll try to stop and see if there's any questions in between that I could tackle for anyone interested. So, but let me jump in and start with on that introduction that Visa gave, maybe with a bit of background, and we can actually jump into the session. A bit about myself. So Sivenathi Sipaka, as Visa said, I'm trained as an actuary by profession, but I in my day job, I work as a CFO of a company called SM Tax, which is a digital accounting and tax firm. And I think over time, and what we're doing now is really more small business advisory, holistically speaking, and I guess in a nutshell, we want to make sure small businesses are equipped with all the financial knowledge and tools available to them. And so that's why we exist, right? To empower small business owners from a financial point of view. And so this whole session is really tailored for the small business owner that wants to gain more insights around the process of financial forecasting, how that works, what that is. And we're just going to debunk or really break down the whole process. And the reason I think I would really enjoy any kind of engagement on it is to be able to help anyone that has thoughts think through some of their challenges with the topic if they've attempted it in the past, or maybe find ways to really add value to your thinking in that regard. So without further ado, let's go into my slides. I only have one page that I'll really focus on, and it's really to set in these questions or thoughts ahead of the time, right? So I'm just going to go on to the slide, and this is really all I'll be covering in the session, these 3 pointers. I want to break down the process of financial forecasting, what it is, what it means, and what, if you're trying to go through this exercise at any point in time in your company, what it entails. And so I'll deep dive into that whole process and spend a chunk of time there. But I want us to also progress, right, to how to use financial forecasts to value your business. And so it's important to not just know how to do the exercise and use it on a day-to-day basis as a tool, but really to understand how we can use forecasts or the role of financial forecasting in valuing a business, and to understand what business value means in general. And then lastly, we'll speak a lot around I'll talk to you guys a lot about scenario planning and sensitivity testing. And these are very common terms used in different contexts, but in the context of financial forecasting, I want to really zone in around what that is and why that exercise will be critical, especially in the COVID-19 pandemic period, to really focus on that kind of element as well. So if we just go into the financial forecasting topic, right? What is financial forecasting? So as I speak through here, this is the only slide I'll have open to just help us refocus at times, but I'll be talking through most of the content. Okay, so financial forecasting is really an exercise of looking into the future, I would say, in very simplified terms. It's looking into the future and trying to figure out what may occur or happen in the future. And specifically, we are focusing on the small business case in this application. Of course, it could be the same context for any kind of entity, whether that's an individual or a trust or an organization that's not really a small business. But for all intents and purposes today, we're focusing on small businesses. So this is generally, financial forecasts are generally adopted quite well in the corporate space. So with big businesses, almost part and parcel of doing businesses is getting into a process of understanding what our forecasts say about what's going to happen in the company financially, in the either near future, medium or long term. And for small business owners, we found that this is really a huge area either of improvement or that's just purely lacking in the small business owners process of managing their business. However, we obviously believe, we as SM Tax believe it's key to have this as really the cornerstone of planning for your business. And ultimately, I think even I personally believe from day one, you should have some kind of understanding around what you expect from your business financially going forward. So a lot of people, so this topic doesn't come naturally to a lot of people. You don't find people just chatting about financial forecasts over coffee, but it's generally one of those things that I believe we need to talk about more and simplify and debunk and get into it. What is financial forecasting? And I think we need to find value as entrepreneurs to invest any time or in an exercise that's supposed to help us. We need to really understand the value of doing such an exercise in our day-to-day business, and ultimately in the business of making money. So does this exercise add money to my bottom line, to my company? Is it worth my time? And if it is, how do I quickly get up to grips with it and start applying it in my day-to-day kind of life? So I hope that post this session, I would have answered a lot of these questions. I've kind of shown you how critical this exercise is to managing your business holistically, but also really to set it up for success and growth. Because I think that's one of the areas we found as a reason for companies, small businesses not growing, or for small businesses failing after a very short period of existence. And so so back to the definition, right? I'm not going to go into any technical jargon or textbook style definitions. I'm trying to simplify finance, especially for non-finance people. So, as I said, this is exercise is all about looking into the future and trying to really map out what you can expect to happen in your business, and trying to track the finances of all of those potential actions, right? So you're setting off from day one. There's a particular path that your business will follow. You have, as a small business owner, control over what might happen in your business to a large extent. However, there is a leg of it that you cannot always control or predict well. And so let's first recognize that there are some things within our control that we can manage, that we can control as small business owners. Then there are other things that we can't. And the way you approach this exercise for both of these is to first lay out, what it is about your business, what it is you don't know about your business, what it is you can control, and what it is you can't control. And so there's the known knowns and the known unknowns, and there's the unknown knowns and the unknown unknowns. So it's one of those, if you've ever heard of that, saying there's one of those things where you need to really find what you know, and of those be able to come up with a plan of action. So the simplest then area of focus first is the things you know about that you can expect. And so as a small business owner, you want to lay out your financial plan at the start of every year. If you're at the start of your business journey, that is the perfect time to actually lay out your financial plan. And it's to ask the question, what is your business about? What is your business model? Because ultimately, everything that you try to predict about the future should really speak to your business model. It's not arbitrary things where you just wake up and think, oh, I'm going to make R1,000,000 in 20 days or in a year's time. It's like the question is really, how do I expect to make the R1,000,000 in 20 years time, or in 20 days time, or 20 months time, with the business that I have? Because it's all about your business and this current operational model, and how you can actually then, based on your business plans, um, find a way to make the 20 million in a set time frame, if that is the target. So in a nutshell, what you want to do is delve into your business model, understand how your business makes money. It's the art of making money. How did you decide when you started out your business that you would make money from this business? How does the business make money? And I think second to that, which is also quite important, how do you, as the small business owner, which is the main investor normally at the start, um, get value from the business, out of this business? How do you make money in your personal capacity from this business as a source, of wealth? Ultimately, I think that's all how we should all be thinking about it. And so, in a nutshell, whatever your business model, you decide on a way that you think you will make money. That's point number one. Decide on a way that you think you're going to make money. And if you're at the start of your journey, you have more leeway to lay out a whole business plan, laying out what your product might be, or your service that you'll offer will be, the value proposition to your customers, how you'll market it and get it to market, what your distribution channels might be. There's a whole process you go through around business development. And key to this question is, it should be, how will you make money from this, right? So through all of this exercise, you're finding a way to have a product that the market will accept, and ultimately you'll present a price for this product or service that you hope your customers will receive or accept. And I think just from an equals 101 point of view, that is creating value, selling a good or service that you can agree at arm's length with someone else, that or someone that wants to acquire that service or product, a set price. And so demand and supply do apply. But once you're in this business, you've learned a lot. You kind of understand who your customers are, and what you can sell them, what the value is to them. But it starts with that question: is what can you possibly get as revenue, or as payment for your goods or services? And because ultimately, to have a business, you need a product or a service. You need some people in your business to help you sell this product or service and to implement on it. You need systems or processes to help you become efficient in that process. So this leg of financial forecasting tries to look at that process of creating value creation. This is through creating products or services that you can sell. It's also then how you take it to market, how you implement on it, because we need to make sure our forecasting, our business model comes through in our forecast, how the operations act or tie into that. And ultimately, like I said, your people also come into your forecast, or any other processes that might have financial implications. They all come into your forecast. So you can start to understand how your business works financially. It's really linked to your operations. Okay, so if I just take then a step back and say, what is this value that we want to forecast? We want to be looking at ultimately the financial activity happening in a company, whether it's money coming in, money going out, debt being created, or debt being given out, whatever it is that's happening in your company, ultimately must pay the company. There's what this concept we call the bottom line, which means really the profit that you expect to get from this business at the end of the day. And the people that own this profit are the shareholders of a company. And those people are invested in the company to extract this value through their equity or share in the company. And so if you're a small business owner, that's normally just one person that is the shareholder. It's the person that would have started the company. There might be a few of you. And for you, the question you ask yourself is, what value can you extract from this company? And at the end of the day, in very simplistic terms, shareholders own the profits of the company. And so their whole focus is really around this bottom line called profits. And whether they get it each month, you get a profit each month that's declared by the company that the shareholders get to own and claim, or whether it's it's you tracking it only yearly, or you're tracking. I think those are the common, frequencies. Ultimately, that is the profits that any shareholder can then take out of the company and pay themselves. And so the real value that we are trying to forecast here, that we're trying to look into, is our profit number, and to almost create to really track it closely to understand how did the profit moves and how we want it to move, and ultimately to even decide or say, how do we control how it moves? I think that's a position of power you want to be in your company, is to say, how do I make sure that the trajectory of the profits of my company is controlled, and not just happens as and when, and it's something we reflect on, but let's be more proactive around the actual bottom line we see at the end of the year, the end of the month, or the end of the day. So forecasting is all about that, trying to control ultimately the story that can be told about the finances of your business. It's about trying to control how the profit number moves up or down each day, each month, each year. Right. And so that's the core of it, because that is ultimately the value that shareholders or any other person that has an interest in the company stands to gain or lose its profits. So what makes up profits then, if we are really delving into it? Profits, just from, I'll say, textbook, but without really being too technical, there's money coming into the company from its main business, operations. And so this is kind of a day-to-day activity of any business. So you'd get customers paying for the service, clients paying for it, or this product that you're selling. And so that is the lifeblood of any company. It's sales, sales, sales if you are selling a good, or it's, fee income if you're charging a fee for any services rendered. Those are the typical models, right? There's commission income, there's different sources of income. So for your business, what is your main source of income? How do you get that in? And so that's then the top line that you must think about in forecasting. So you want to first get your top line, identify your top line and know what it is, and really delve into what drives this top line, this revenue number, whether it's, like we said, sales, or a combination of sales and service, fee income, or commission, premium income depending on your business model. There's money coming in. So understand the income streams that your business has, and let's find out what is the main source of income and any other income that you can possibly get from your business. So that's the first part, is understanding that and really delving into how it grows. How can you control the way your revenue grows? And so this really speaks to your business plans that you have lined up, whether you're doing business development solely as an entrepreneur, or if you have outsourced that to a part, or if you've got consultants helping you. But that is really the way to grow your turnover at the end of the day. Your pipeline of deals, that's what you must consider in this exercise of financial forecasting. But our aim is to say we need to create an expectations for the shareholders or ourselves of what we expect the revenue to be tomorrow, today, tomorrow, next week, next month, by the end of each period that we're looking at forecasting or estimating into what's the target that we're setting for ourselves as revenue. And so that it will be based by your business plans, by any kind of pipeline work that you've already predicted. So exercise number one is create a pipeline of work if you don't already have it. Try to guess or estimate really what that number will be, just flat out. But what's more important is not to guess, is to then realize that in doing this exercise, you are actually setting assumptions. You are assuming something about the future sales of your company. You're assuming that you will firstly make sales or, like I say, earn an income from this company in the next day, in the next month, or in the next year. And I think what COVID-19 has taught a lot of people, or of people have been able to reflect on, is that you can't always know for sure what the future holds. You can set an educated guess around what that might be, and that's what we call assumption setting, right? Assumptions are supposed to be educated guesses around what might happen in the future, and not they could be based from your historical experience and what you used to. Let's say at this time of the year you're used to getting sales of this amount because it's seasonal, and so that could be a good way to base it from historical experience. Could be from data around your competitors, etc., and you could come up with estimates of what you expect your sales or revenue to be. But what we've learned from COVID-19 is that we cannot entirely predict the future, and I say there are those things that are outside of your control that you must factor in. So then the question is, what are reasonable assumptions to set? And we call this, I guess, in our finance or actuarial world, is that you have a set of assumptions that you want to set. They must be based on, they must be more best estimate assumptions. You mustn't be trying to be too optimistic when you're setting your assumptions for forecasting. If you are too optimistic about the future, and I think a lot of small business owners or entrepreneurs are, you would expect that every day of each month going forward, you will make sales. And you might even be optimistic enough about the volume or amount of sales, or the sales number you'll make per day. Let's say you target 10,000 Rand a day or 100,000 Rand a day. And you may think that, based on your past experience, this is good. And based on your pipeline, you actually will get more. So I think you need to understand when it is that you are being optimistic. Being optimistic just means that you're expecting that the future will have a positive outcome for you, in terms of your financial results, and that doesn't always really pan out. So it's not a bad thing to be optimistic. We really need to consider that optimistic scenario. But if you try to be more prudent, which means that you're trying to not to avoid risk taking, then you set assumptions that are not as optimistic. So basically, you look at your worst case scenario, you look at your middle case scenario maybe, and you maybe go with something that's not as optimistic about the future. And so really the approach that I'm suggesting here, that quite works well for, at least when you're starting out, is to constantly think and try not to be too optimistic or not to be too prudent, but rather to find that middle ground, and we call it your best estimate assumptions. around the financial performance of your business. So with turnover, don't be too optimistic, right? Um, so that's key to the lesson, because assumptions drive forecasts. It's not just the calculations you may be doing, it's really the assumptions you're making that make the difference. And that's one of the things that any person evaluating your forecast, whether it's for funding purposes or just your business partners, or yourself, is they might question the assumptions to say that they look a bit too optimistic, given the current landscape. So if you're looking at COVID-19, a lot of people are feeling very bleak about the future. And so it's not necessarily that it would be a bit, if we saw financial forecasts that seemed very optimistic, that's told a perfect picture of profits, untouched profits going forward, someone might think that's a bit, the assumptions there are really not reflective of the current situation of COVID-19 pandemic, but also maybe a bit off. And so you don't want to be too optimistic. It's better to err on the side of prudence. And obviously things turn out better than expected, then great. So that's lesson number one, or that's really the main point, is assumption setting is key. And I think then the question is really on the calculations side. Other than revenue, what else must you include in your financial forecast? And how must you do this? And so besides revenue, right? I spent time on it. That is the most important thing to forecast, is your revenue. What do you expect, like I said, over any period of forecast? So that's number one. Two are your costs, which is then all of the expected expenses that you'll incur, that the business will incur. And you break down your costs further to say, what are more direct expenses that I expect my businesses to incur? These are the expenses I can't avoid. They are definitely linked to me even getting this revenue in the first place. So they're directly attributable to the exercise of getting a revenue or money in. There's no way you can forego these expenses. And so those are quite key to reflect in your financial forecast or to model. And modeling just means trying to represent the future today, looking into it and saying, let's put it down onto some kind of system or process or a document that actually shows us the future. And so that's what the model is. It's supposed to reflect or be reflective of the future, but the model gives you a forecast, so in a nutshell. So I use these terms interchangeably, but the model is a tool that we use to come up, which has these calculations in there and these assumptions in there to come up with a forecast or the result, which is really just a picture around your future, expected future outcomes. And so then it's those costs that are secondly important, is what are your direct costs? So understand what your direct costs are. What are those things that are linked to revenue? As revenue increases, those would have been increasing as well, as ultimately you cannot increase your revenue without incurring these costs. So in the simplistic model of a company that sells, and maybe this is the most easiest example I can think of, that sells a good or service, well, let's say it sells a good, for that business, all of the inputs and materials, if they do manufacture this good, that are involved in the manufacturing of this good, may be seen as your direct costs. You have to, ultimately pay for or get inputs in to whip together this product that you'll sell to the market. If it's something that you're buying from a supplier and just reselling, then your costs there, your direct costs are the purchasing, the cost of purchasing, this item before you can resell it. And so try to identify those direct costs of doing business. And I think maybe also in a service business, I can use this example, which is also quite important for service businesses to understand their costs, their direct costs. And we find that a lot of some service business don't necessarily understand the distinction between their direct costs and the indirect costs. So for a typical example, if you're an IT consultant, just going to make a random example, and let's say your main revenue stream is consulting fee income. So you're an IT consultant and you effectively have some clients and you charge them for all the time you work on their projects, etc. So in your case, that would be your main source of income. And if you work, by yourself and ultimately end up having too much workload, you might decide to outsource some of that work to other IT consultants. And so then they also then charge you for their time in assisting you with your project, right? And so in that kind of model or scenario, the outsourced IT consultants would be the direct cost involved in getting or that revenue that you'll get from the customer at the end of the day. So you'll be charged some hours. You have to pay out some IT consultant fees to your IT consultants that are outsourced, and then you will then invoice your customer ultimately for your hours as well as of those of the consultants, maybe with the margin that you've added in for profits. And so that's another simplistic kind of model to think about. And so in these two examples, you have your revenue, which is what you expect to get from your customer at the end of the day. That is your the price of the product or service. And what you need to account for is then the actual direct expense that you need to incur normally before you get this revenue. You have to normally pay it upfront before. And so it's quite important to know to be able to then map out and say, these are my revenue, these are my direct costs. So that's the first thing. And once obviously the revenue minus the direct costs, you get your gross profit number. And this is a nice number if you're looking at the traditional income statement approach, is to say that gross profit tells you a lot about the ability of a company to make profits. And so what we generally measure there is a gross profit margin, rather to say how much you have you can expect as if you were not going to incur any other expenses, what you could expect your profit to be after that first payment of direct expenses. And so a lot of businesses that have a higher gross profit margin are generally setting themselves up for success if they can get away with it, right? And so the idea is whatever your gross profit number is, that will be paying for any other expenses that your company expects to incur in just its normal day-to-day business activities. And I think a big chunk of that is normally salary-related expenses or costs. And that's normally what a lot of people need to really factor in. And that's what a lot of entrepreneurs might have sleepless nights about when revenue doesn't come in as expected. And so what you don't want to do is then underestimate your other expenses. That's what we call it in general. Anything that's not really your direct costs is really your indirect costs, and part of that, or a big chunk of that, is your operating expenses. And top line is, or top of those of that list, is your salary expense. You cannot underestimate any expenses, especially not your salary expense. That is a cost of paying any people in your business that are your employees, that help you in obviously implementing the service, or that help you in making this product and selling it to get that revenue in. And so this whole exercise of financial forecasting is really trying to map out your future income statement. And there's more than one approach. You could look at really trying to just look at your future income statement, which is your incomes and expenses and gross profit. Or you could be looking more at a cash flow forecasting exercise, where you're just looking at tracking the cash instead of just the income statement. And I think it's a good time to then stop and actually try to distinguish, right, the difference between your traditional income statement in general, or income statement approach, versus your cash basis or cash approach. And these are terms that are thrown out there from in the world of finance by accountants, by pretty much everyone in finance, tax people, insurers, anyone. And they don't necessarily always translate to exactly the same thing, but the core understanding or principles are there, right? Your income statement, or your profit and loss, which is another term that's normally used, statement, really shows you all the income line items we spoke about that this company is expected to get in or earn. And it subtracts the lesses, minuses all of the expenses that you expect to pay out, or that would have been incurred over that period. and ultimately get to that profit number. However, I think the key words between the income statement approach versus the cash basis approach is this concept of accrual that accountants like to talk about. So the difference is just really when to recognize revenue and when to recognize an expense. So if I make a small example, right, um, a lot of the time when the time at which you incur an expense is not necessarily the same time you pay it out as a business. So you might get an invoice or bill today that has to pay, let's say for electricity. The due date is the end of the month for when you need to pay that electricity. So by virtue of that invoice being dated today, the date at which you incur that expense is today. So in that income statement, you would expect to find that expense in that income statement for dated today or for this month. But you may then find the payment of electricity in the next month's report and not this month. And so we track normally expenses and income separately to cash flow movements, because your income statement does not always show the cash flow movement. It just shows you when the incomes are recognized for reporting purposes, and it shows you when the expenses are recognized. The payment of those may be later. But of course, the reason I'm touching on this is that the date at which you recognize things is quite important in your forecasting. So you want to really be on top of your cash flows as a small business owner to prevent you getting into a situation where you've run short of cash flow, or the time you've mismanaged the timing of certain cash flows, and at that point in time you can't meet the cash flows due to the business. I think the more important element is to look at your cash flow forecasting aspect, and not just mapping incomes and expenses. Question it: when does it become due? What's the timing of the income? What's the timing of the expense? And then if you're trying to if you get that cash flow management right, it's to really make sure that the timings are, you can align the timing of your cash flows, incomes, and your outcomes. So you want to make sure that any short term, for example, outflows of money that you need to make soon in the let's say foreseeable future. Let's say set a date, end of the month. If you're expecting to make payments at the end of the month, you must try to find money that you can use, or expected income you can use to pay for that at the end of the month. So we use this term called matching of cash flows to be able to meet your short-term commitments or obligations. And so in high level, what I am trying to really emphasize is think about cash, because cash is king, and not just your traditional income statement where the dates are not, I really speak to when you recognize income and expense. You really need to know when does the money also flow that's linked to income and expense. Okay, so in a nutshell, going back to the process, you have your revenue, you have your direct expenses, and you have your other expenses that you want to include in your forecast. And effectively, after paying for covering all of those, you should have your profit number. There's other things that you might want to account for before really reaching that profit number. But the gist of it is really your operating expenses that you want to focus on for your cash flow forecast. There's, let's say, administrative expenses that may not be operating expenses, and a few other things that may not really be. We spoke about employment costs, but we need to lump them in here and really consider them as your operating. Well, they are really under your operating expenses, and so that is then the exercise. Focus on those things. Focus on your revenue, direct costs, and your operating expenses. Then you go into each of those. We've tackled the revenue question. What dictates your revenue? What drives your revenue? So think about that. What drives your revenue? And how do you have any control of your revenue? Your customer, your potential customer, or is it you just wake up and you've got clients lining up for you? So I think to really be on top of your forecast, you need to understand how the money comes in, and to be on top of that activity that brings money in. And so you, to a large extent, you'll then have the confidence to set better forecasts around on your business. Um, so that's a revenue question. But I think, again, if I reiterate the importance of the assumptions you said there, even if you do have control of your revenue cycle or who your customers are and how they pay you and that kind of thing, you still need to make sure that you are not overly optimistic about your future when you're setting assumptions. And assumptions, the two most important for revenue is really normally volumes of business. It's actually three things, sorry. It's your volumes of business. So how many sales do you actually expect to make of this product? Or how many hours do you actually expect to charge um, for your consulting work? So how many units of the product or service do you actually expect to sell and get as revenue at the end of the day or the end of the month or the end of the year? And so that is an assumption because you don't know what it will be tomorrow, end of the month, end of the year. And you, like I said, you can refer to your past experience, you can look at your track record, you can look at your competitors, you can look at the current market to try to get a good sense of what that volume might be. If you don't have a large share of the market you're in, you need to devise ways to get a bigger share of it, because that's the only thing that would drive up your volumes, right? Is to get a bigger share of the market. And so we look to business development exercises to increase this assumption, your volume of business. Then there's also the question, again, is really the price that you're selling it for. That's the second assumption. So the price is normally something you set up front. I think the only thing that's unknown about it is whether your client will accept it or not. So will your client accept the same price you had if you charged them before? And if it's a new potential customer, will they accept the price that you're offering them for your good or your service? And obviously that's dictated by a lot of other economical factors. Economic factors, especially if you think about this pandemic, caused a huge recession globally, and a lot of people struggling to pay for basic goods and services. And so the question is your price fair enough? Is your price considering the global pandemic? Are people or your normal customers or potential customers willing to pay the same price they would have paid before the pandemic in this climate? And so you need to ask the price question when you're doing a forecast, and ask whether it's reasonable to assume that the price that you've already set is correct or not. And you need to test this assumption. You need to offer people and get their opinions. Look at your competitors. What are they charging if you have any competitors? And so it's not an easy question, but a lot of companies will say, I've charged this price for the last however many years, and I've got clients that are willing to pay for it, so I'm fine. And in that case, I would say then that's a reasonable price to include as a price in your forecast. However, consider the unknowns and what might impact your pricing in future. But just basics, if you're happy with your price, your customers will accept it, then that's great. More so if your price covers the cost of purchasing this good in the first place, or the cost of servicing this product, and it also covers a nice profit margin for yourself, then I think in your forecast is a good price to use, because obviously it will be expected to pay for these expenses we mentioned, and it will be expected to pay for the profits that the shareholders also want to get from the business at the end of the day. So make sure that the pricing exercise is a fair exercise for your customers, but really to make sure that it does cover your costs and set your company up for profitability. Okay, so that is then the price as a secondary assumption that you're making. And then the third assumption is really a lot of people don't miss it or don't think about it well, is your mix of business, right? So and it really applies to a lot of businesses that have different types of customer segments or people. And so it's a huge risk to companies that don't recognize this assumption in their forecast, that they're not always selling to the exact same customer persona or same customer. So customers behave differently depending on their personal circumstances, whether it's their financial, setup or financial ability, whether it's their cultural, or beliefs and culture that dictates their spending patterns or what they consume and buy, whether it's their religion, families, and there's a whole host of things you can actually bear it down to. But And there's obviously a lot of people studying behavioral customer behaviors and the economics of it, to understand how customers make that buying decision. But in a nutshell, look at your base of customers that you've serviced before or that you're hoping to service, and ask the questions: how do they differ? Uh, and what is my ideal customer? Because that ideal customer that you want would have some traits that you've identified as good for your business. That's the type of customer you'd like. Obviously, there are things like customers. We could assume that customers that are more financially well off can afford your service. Sorry, just getting some distractions. Sorry, I'm on a call. Sorry, getting some distractions here from home. Just gonna go back into it. Okay, so look at your customer and look at whether your customer, segment your customers and look at the types of customers you have for your business, that are willing to buy your service or your product. And so the things that make your customers different, right? Those are sometimes good things or bad things, but it may mean that if you get customers that are not the ideal customers for your business, you may have issues along the line, let's say from collecting debt, customers that maybe don't pay on time. You may have issues where customers complain a lot and don't, let's say, value your service if you're trying to just sell to any customer. You might have customers, I think there's a whole host of customer issues you could have. And I think what I'm trying to illustrate here, it is important to look at what your customer's ideal segment is and the people that won't fall into that. You must also then try to estimate or measure, or be very, let's just say maybe be very proactive about it, and be very intentional about trying to sell to your base, to the customer that you are trying to attract. Because if you end up selling more to the customer that you're not trying to attract, then you definitely won't meet your short-term business plans. Or you know, if your whole financial forecast was assuming that you would be selling to the customers that are your ideal customers and you end up not doing so, then you may not, that forecast may not pan out in reality. And so, for example, in the example of bad debtors, you may have more bad debts than paid debts, right? So it means from the cash flow point of view, you won't have collected as much revenue from your customers if you sell mostly to customers that are bad debtors or that are more likely to be bad debtors. And so really look at this question around business mix. You want to have a good mix of business between customers, and try to find the types of customers that you should be selling to make a good margin, and target them. Be very intentional and know that if you don't sell to them and sell to other customers, there are risks that your business may face. And so in your forecast, you want to account for it and say, ooh, let's say of my whole expected sales number, if I assume that I have 20% of cases that are not clients that are not as great, but this kind of customer persona, what can I expect? So I've had 20% of bad debtors or people that have a history of bad debt. Then this is what I can expect from my full forecast, that I won't actually receive this 20% in cash. If I do get it, it may come in month 2 or month 3 or month 10 after debt collection costs, for example. So you don't want to underestimate this mix of business risk that small businesses face without intending to do so, without understanding that they face it. But it can be a huge risk. And for those people that have only 1 or 2 customers, perhaps it's not a huge risk in that sense, but then the risk is that you lose that customer. And so it's just to think about what customer related risks you have when you are considering your mix of business. If you don't have enough of a mix of customers, that may be a good or bad thing, but ultimately, like we say, you could lose that one customer and your whole business financial forecast crashes. And so, or your business model crashes. And so you want to have this pipeline and segment it and then target wow. And based on that, then set your, in your forecast, get that segmentation to come through so you can understand what the risks are that you face for your forecast not actually panning out. Okay, sorry, I'm in the wrong slide. Back to here. And so those are the three things you must think about setting up three assumptions to set for revenue, right? It's your volume of business, your price for this new business that you expect, and ultimately the um, the mix of business. And for those clients for those businesses that have ongoing business, let's say a retainers or contracts with ongoing contracts to service or supply something on a recurring basis, it's the same assumptions you must ask yourself around even the base of customers you have. Can you continue to have this base going forward? Or will it lapse at some point? Will it fall away due to whatever reasons? So that's a volume of business question. And you know, the price, can I expect to charge my base the same price I charge them? And in the COVID-19 example, you'll see a lot of the subscription-based businesses reducing their costs over lockdown period in order to retain some of those customers to get the money in, but understanding that maybe their customers can't afford to pay the same price. So you've seen a lot of, for example, insurance companies offering discounts on their premiums that you would normally pay for your insurance, because for them it's about retaining the business and getting monthly revenue in from their base, and if they lose that, it's difficult to rebuild that. And so if you are that kind of business, you must be thinking around those lines to say, in my forecast, I can assume that these customers I'm with will continue on into the foreseeable future, but you know, some of them may drop off, and so I must account for that drop off in numbers. And then in terms of price, I may be forced to reduce the price based on the economic situation in the country or globally. Um, Speaking of for a certain base, ultimately, and then on the mix of business, I may end up losing some clients that don't value insurance, maybe in the insurance example, and I may be stuck with people that really value insurance but claim more, and so I'll pay out more claims cost than what I get in as income. So think about those kind of examples in your model to say, what are the risks of your mix of business changing? What are the risks of your volume of business changing, and what are the risks of your um, the price for your sales or service fees changing? And so that's the chunk of it that matters the most, is the revenue question. But I think post revenue, this is when your operations kick in. Someone has paid you to offer a certain good or a service, in my very simple examples, and you then need to go and implement this service, or you then need to go and produce this good, or you need to go and buy and sell and do something to service your client. And so normally there are costs involved in doing all of these things. And so when I spoke then about operating expenses and direct costs, that's the, like what I said, is you need to zone in on how your direct costs move with revenue. Is it a percentage of revenue normally? Is it a fixed amount per unit of revenue? So think about how your direct costs move in line with your revenue. So in the example I used, you get charged an hourly rate for that IT consultant. You get charged an hourly rate by your IT outsourced IT partner, and you also then um, charge an hourly rate to your customer. And so those are quite linked. The hourly rate you get charged, you probably will take that and add a margin on it, let's say 50% or 40% profit, and then that's what you charge your customer for that, for their time, for that service. And so in that simple example, they are directly linked, percentage wise. So any increase in your revenue, in your cost, is likely to have the same percentage increase in your revenue. So if your consultant increases their cost by 20%, then in your forecast, you must allow for an increase of 20% in revenue that you can expect from your customer. And so those are the kind of things that you must try to measure and say, how is my direct cost linked to revenue? Is it normally a percentage, a direct link, firstly, increase, or is it an inverse relation? You know, if this increases, that goes down. So think about, which is not likely for direct costs, but in some contexts it may be that case where it's not, let's say, your normal fixed expenses. And so So consider that relation, how the actual cost links up to revenue. And when you are forecasting, have that come through. Make sure that you are including your expenses in a sensible way. And they must, for the level of revenue that you're targeting, they must be proportionate or make sense for that level of revenue. And so, and as your in your forecast, as your costs change, direct costs change, your revenue must change accordingly. So your forecast must be a bit more dynamic than what you may be thinking maybe upfront. When there's a change that you can expect in your business from a certain action, you must make sure that's captured by your forecast. That those costs change and that those revenues change in line with that one action, if that is how your business normally operates. So you want to set yourself up or have a dynamic model that can change with certain inputs and factors um, when you do your calculations. And so that's your direct costs, the same as your operating costs. You need to make sure that those are changing in line with your normal business activity and are reflected in your forecast. And so I think one of the things that people normally underestimate is the cost, that employment cost line item. So you know that we've got fixed salaries to cover each month. Let's say, and this isn't a case where there's other business people in the business besides the entrepreneur. Or it could be that you are the sole person in the business, but you pay yourself from this business as your main source of income. And so you want to set a minimum, at least, target for your own salary out of the business. Whatever those numbers are, they are normally fixed month to month, and they normally change with some reviews or some processes that you follow in your company to increase salaries. But that's the one number people know upfront, that I need to pay my staff, let's say 100,000 Rand a month. That's my total salary cost. Or I need to pay my staff 200,000 Rand a month, and that's my salary cost. And so it's easier to forecast or to estimate that, because it's agreed contractually with your staff that for each month worked, etc., there'll be a certain amount payable. Some of it is depending on hours worked, depending on the industry you're in, or it may depend on, deliverables, or you may be paying people based on having made certain milestones, or progressively so. And so whatever the case is, make sure that is included in your model, and have that monthly cost there. But what I'll challenge you to do is, don't just look at the cost side of it. Look at really the ROI that you expect to get from incurring that cost. So what return or what value does this person that you're paying, that's an employee, what value are they going to deliver to the company? And can you find how that adds to your turnover or to your revenue number? Because ultimately, everyone in your business, even if they're doing admin to a point, must really be adding, to your bottom line. They must be adding value, in either helping you fulfill the service, or operationally, or good, deliver it to your customer, whatever it is, or to service your customers. But there must be some kind of value you're getting from them. And so you want to then measure that, for each target revenue that you have, try to work back to what resources or people you need to implement on that portfolio of customers. So in whatever you're forecasting for revenue, it can't be blind to your people. So don't neglect, or don't forget that it takes people, let's say maybe in your business model, to get to that revenue target. So sometimes we review and we look at a lot of financial models or financial forecasts, and we struggle to find how, as the revenue grows, the other expenses will move in line with the business growth. And so we then end up finding unrealistic financial forecasts to that end. So recognize that if you're trying to grow your revenue, or if you're forecasting a growth in revenue, we must also be seeing, to some extent, not just a growth in your direct costs, things that you have to incur, but also in some of the fixed costs that they may be fixed at a certain level of revenue, but they are normally, um, they can only increase with higher levels of revenue in future. And so the relationship between revenue and direct and your fixed cost may not be as is not direct, But generally, there's an increase in cost that you must account for when you are doing your financial forecast, especially if you are looking at if you are including an increase in revenues in your forecast. So be careful around those just setting assumptions for revenue without considering the implications on cost. I think that's really the point that I'm trying to make here, is that link them up and be able to speak to these costs. Do they make sense for that level of revenue you are depicting or showing in your projections? Um, um, and so you can forecast something that makes sense for your own managing of the business, but also for any other stakeholders that are interested in this question. And so that's probably all I'll say on it. Just be careful on that point. We could have a whole hour discussion around modeling your expenses better, that they reflect at least the reality of it, and that you are able to map out the value that each, let's say, employee has on your bottom line, finding that ROI and being able to include it in your forecast sensibly. But don't, at least at the basic minimum, do not neglect to think about it or be able to answer that question around your forecast. So think about it and really delve into the workings of it. And some people, of course, are very you could say clued up on their operational capacities, and they're able to answer this question better around capacity. So for this level of revenue I have, what's the actual capacity I need in terms of people, and what cost do I need to pay those people to have that capacity? So some people are very close to that answer, but if you're not, just do a bit more work around that question, because it becomes key when people evaluate your financial forecast. And so so that's then the question around operating expenses. And so ultimately, at the end of in this exercise, all you are doing is you're taking a piece of paper, an Excel spreadsheet, a funky system that has forecasting at your fingertips. Whatever system you're using, you effectively taking some expected numbers or about the future, turnover, direct costs, operating costs, you're putting them in there. Turnover minus your direct costs gives you a gross profit, minus your operating expenses, maybe in a few other things, but let's say minus operating expenses gives you your net profits, and that's really the profit number. And there's other costs, tax, etc. you need to take into account, and a lot of these then are not technically expenses, but really debts that you owe SARS that you must account for. So if you're doing cash flow forecasting, you must really think about having to pay other debts, including tax, and how to then include that in your forecast. You cannot miss those things, or loan repayments that you have to make that may not be in your traditional income statement model. But you need to look at them for matching those cash flows that we spoke about earlier. And so that would be your exercise. Then you have in your forecast, if it's done on a month, if you have a monthly, if you're laying out your forecast on a monthly basis, let's say for the next 12 months, you're doing a forecasting the next 12 months. At the end of each month, you've got your turnover listed, you've got your expenses listed, you've got your profit listed. So that profit tells a story. You may see that month on month is going up and down, or it's increasing each month or decreasing each month. So you must evaluate how that is moving each month, and to see whether you're happy with that movement of your profit number each month. And if you're not, then start to question, how can I make the results of my financial forecast better? Because as it is, I am not satisfied for whatever reason. I feel like for the investment of money, time, sweat, tears into this business, the profit number is not satisfactory enough. It's not high enough. It's not paying me enough. Specifically, if you look at your profit number as a percentage of your revenue, so just take that number, divide by your revenue, and you're not happy with that number, that margin. So then it means you're not happy so it basically means that after revenue you made, the amount you get left over as to give yourself as net profit, and I'm saying yourself because I'm assuming you're the sole shareholder, that all the profits belong to you. But but that number that belongs to the shareholders, you want it to be as high as possible relative to the revenue. Ideally, you'd want to keep all of the revenue that you collected, right? But of course, you first need to pay some expenses, and whatever's left behind is for the shareholders to keep or to reinvest in the company. But that number, if you're not happy with that number, and it's a small proportion of your revenue, then you need to ask yourself the question, how can I really make that number bigger as a percentage of my revenue? And so you can either increase your margins, like we spoke about the customer price, or you could, and then in that assumption, but be able to justify why you're doing so. Or you could reduce your expenses, find a way to cut down on expenses, wasteful expenditure, um, expenses are not really core to the business, or not even business expenses. Say, let's say you have some personal expenses. If you are your typical entrepreneur starting out, will run some personal expenses through the business. Try to get away from that, because it makes your business finances look bad. It makes your business finances look like, it makes your business look like it's incurring more expenses than it is to operate. I mean, that's not true. It's incurring expenses to pay you, but not to operate. So let's find those key expenses that are incurred for operational purposes. Let's project them. And if that margin is still not high enough, if the profits of the company are still not satisfactory, find a way to cut down on your expenses. And that really means having just a more lean way of operating your business. So find ways to cut down on wasteful expenditure, find ways to increase your customer value or the price without increasing your expenses. It's a very difficult thing to achieve, but if you can find ways to improve your customer value or the service or the product you offering, so that you can get a higher premium from your customers, but without increasing the costs, that is probably any CFO's dream, right? Because ultimately you'll be able to improve or increase your profits effectively. And that's probably not really the only way, but that's really a good way to increase your profits, is is to manage the costs associated with your business. But I would be yeah, it would be unfair to not mention that really what drives your business is revenue and sales, and not necessarily your cost cutting or improvements. So think about both of those things when you're doing this exercise, so you can improve the profit number. But besides the actual absolute number, like what it is, let's say your profit is 200,000 Rand that you've projected for next month. And maybe I'm being optimistic because it's COVID-19. Let's say it's a 10,000 Rand. Try to find how you can increase it in the following month. And the only things that really drive it, if I remind you, is those revenue targets or assumptions. So selling more, selling to the right customers. We can charge them a better premium, you know, and it's, or increasing your price or whatever it is. Target that and ask yourself how you do that, and that's going to tell a better story of your expected performance. But don't do it blindly. Have good reasons for setting those assumptions around revenue. Have good assumptions then for setting those expenses that you will incur. Some of them are fixed, which is great. You know the amounts that you're looking at. What you don't know about them is that amount reasonable for the level of business or turnover you're expecting? So you may have to increase your salary base after a certain level of revenue. So consider that. Some expenses increase with inflation, and so consider, if it's an inflationary time and there's high inflation, consider including inflation, especially if you're forecasting over 12 months, more than a year ahead. Prices change over time of general things, so the cost of your telephone bill may not be the same next year. So you need to make sure that you do allow for normal price inflation in your forecast when you're looking at expenses, especially. You might also want to look at interest rates that change, and some of your costs, for example, your interest expense cost changes with your with the interest rates, right? With the market rates for lending, the repo rate or the prime lending rate or whatever, or if it's linked there. And look at those things and take them into account when you are looking at that interest expense assumption, when you're setting that expense assumption. take that into account. And so it's those small things where you may misunderstand or not account for that then at the end of the day does not prepare you for the future well financially. So you want to be very thorough, you want to cover all your bases, and you really want to make sure that you understand your business model so that your assumptions and your calculations are sensible, but also that you are you're not, if you're speaking around the assumptions, you're not too optimistic, you are, let's say, even on the prudent side or somewhere in between, that then you would have at least said reasonable or believable assumptions that are obviously at the core of your forecast. Um, and then in terms of calculations, it's just basic, adding and minusing, adding your revenue, subtracting your expenses. That's the most basic kind of calculation you can do in your forecasting to achieve a basic cash flow forecast. There's other funky things you can do, but for all intents and purposes, the most critical is really your just looking at your expected future incomes and outcomes to get to that net cash flow or that net profit number that you're forecasting. And we reiterate that is what really the shareholders of the business would be most interested in, because that is what they earn or get from the business at the end of the day. It's at that bottom line. And so once you have then this schedule of profits, we can sometimes call the profit signature. If your profit signature is showing an upward trajectory that is going to grow nicely over time, I think any shareholder would be happy to see that. And the stakeholders, and you obviously can speak to it because you would have taken into account all of those assumptions that we spoke about. But if it's not showing that, then you have more work to do because you can't be satisfied. And so what we talk, well, with the negative result, if your profit is expected to go down based on the assumptions you've set month on month, then you need to do more homework. Find out why, find the causes or the levers for the revenue and what's really making the costs higher, if that is the case, and get to the bottom of it so you can be more preemptive. You prevent that from happening. So the whole exercise of forecasting is to be able to see potentially the future of your company financially and look at the future profit and loss statement or income statement. Look at the future balance sheet and say, are you happy with this? You know, before you even get to that point, and to be able to be preemptive or to be preventative, prevent anything that's expected to be negative before it happens. And so that's the biggest value from doing any financial forecasting, is you don't want to be reactive in any kind of situation around the future. You want to be proactive about it. You want so that you can expect it, and if it does happen a certain way, at least you know what to do about it. You would have thought around some ways to mitigate that risk so that it doesn't actually happen. And if it does happen, you would have thought around what you can do to manage the situation at the time. And so it's a tool to use. It's an exercise to do to be ahead of your financial future, if I can put it simply. And that is, in a nutshell, what financial forecasting is. It's less about that final number, but it's more around the assumptions and understanding the impact of those assumptions. And it's also about the calculations you do to say, how does the numbers work with each other? How do they relate to each other? So that they're not so arbitrary and that they make sense based on your company. And that's really what it's about. It empowers you to be on top of your future finances, way ahead of time, and to set those plans that if you have found those things that are a bit risky, then to set those mitigating strategies up front to say, if this happens, this is what I'll do. If that happens, this is what I'll do. If this happens actually and the performance is much better than expected, then I'll be happy and my shareholders will be happy. And so that's what forecasting is about. But I think to just add to that, right, that is all based on assumptions. And we're going to talk about this concept of scenario testing and sensitivity testing because it speaks to assumptions, and it challenges assumptions that have been made for any kind of forecast to say whether those assumptions are fair or not fair. And yeah, and ultimately, in a forecast is only good as its assumptions. Have a bit of internet connectivity issues, but I think we're still good to proceed. Um, and so I want to cover those that in number 3, but let's first talk about in a few minutes this concept of valuing a business. It links quite well to this whole financial forecasting module, because forecasting is one way to actually do a business valuation. It's one of the methodologies that can be used in valuing a business. And so a lot of people, and I put it in as a thing to mention, because a lot of small businesses I've come across and that we've seen at SMTax, I think they struggle a lot with this concept of putting a value, attributing a value to your business, saying what it's worth, whether they're trying to sell their business or getting into other partnerships with other stakeholders that may be interested in, let's say, raising capital or getting shareholders in general. They struggle with this question of, what is my business worth? How do I value my business? What can I just come up with a random number that can be accepted by the market, or how do I really value my company? And so what I want to say, having covered just a bit of thinking or talking around financial forecasting, is that really, as a shareholder, anyone that's expecting to get value from a company or a business, and those people are normally shareholders, those people, shareholders, really stand to gain profits from a company. That bottom line we refer to. And so for me, this is just a school of thought, that the best method to use to value your company, or any company really, is to really look at the future expected cash flows in and out of this business, and understand how they lead this business to a profit number each month or each year. And then those future profits, that is what I will stand to gain as a shareholder. So if I want to buy your company or invest in your company, I'm really interested in a lot of things. I'm interested around who you are, what the business is about, and the story of the business, the vision, to see if we align. But I'm really interested as well in the bottom line, in that profit number. What profit can I expect to get from this business in the future? Because if I'm going to be the only shareholder, I'm buying it completely from whoever the current shareholders are, and I'll own 100% of the company, I need to understand what profit it will pay me in each year going forward. And all of those, because that's all I'll get from this company, is future profits. And I could also sell it again at some point and get then, you could call it a gain on whatever I've paid now for it. I could get a gain on that if I sell it at a premium. And so we call that more of a capital gain type of exercise. But what you need to really understand is, as a potential shareholder or investor, is what profits you can expect from the company, in future. And that's what tells you the value that you can extract from this company going forward. And so this exercise of forecasting helps you as a small business owner try to articulate that value a bit better, to understand what expected future profits any shareholders would have when investing in your company or post investing in your company. You want to be able to demonstrate to them that, based on all the assumptions that you've set, and highlight what your assumptions are, right? And say why they are reasonable or good assumptions to make, because it's going to be down to assumption setting. But once you have those, right, why, and then you've mapped out your future profits, is that stream of future profits attractive enough for your investor, for them to invest in your company? That's a question you need to ask yourself. So that's what you need to sell to your potential investor or your shareholders, or anyone that wants to put money into the company, is that the future cash flows of this business are looking great. Or there might be some dips here or there at the start when you're still building out your company, or maybe you need to invest in ABC. But once you reach a certain level of operational efficiencies, they expect it to spike like this. So you want to tell a story of the cash flows going forward and how those make sense for any investor to put money into your company, because they want to get back those future cash flows. They'll give you something now that they're hoping that the sum of all the future, profits they're going to get will be more than what they paid today. And that would have been a good investment for them because they'll get more out of the company than what they're giving you today as capital. And so that's really, I guess, the angle your investor will come from, but they will consider, the pitch holistically around what the company has to offer in general, any other social benefits, etc., an alignment they may be requiring, but it boils down to the bottom line, to that profit number. So this is a tool to empower you. This financial forecasting, it empowers you to be able to sell your business more fairly than just in an arbitrary way. There's more than one way of valuing a business. I think some business owners or make that mistake of just looking at turnover as a way to value your business and say, I currently make R1 million turnover this year. And if you invest in that company, you're basically investing in that million turnover each of the next 10 years. And so, that's ultimately 10 million turnover. And so it's a good investment. However, they haven't really addressed this question of expenses and costs that will still need to be incurred, and ultimately the value for the shareholder being the net profits or the profits at the end of the day. So please tackle that in your next attempts at this. So if you haven't done this exercise of trying to value your business, try to use financial forecasting as a tool to do so. And then try to get people's inputs around how you've presented it and how you've done it. That should then empower you to just set yourself up for a better pitch for your business valuation. Okay, so importantly, before we close or we go in for any questions, etc., I want to look at this scenario testing, sensitivity and sensitivity analysis and scenarios. So it's kind of the same thing, but one is called scenario testing because it looks at it paints out a whole scenario and really to understand if your assumptions make sense in that scenario for your forecast. One looks at sensitivity it's called sensitivity testing because it looks really at how sensitive your assumptions are to like one factor, or how sensitive your forecast is to one assumption, or at a time, to understand those sensitivities. These are key concepts because if you do your forecast and you've got your perfect next 10 years financial set out there in some spreadsheet or some graph or whatever, and you haven't considered certain scenarios panning out, you're still at risk that your forecast will not pan out in reality. And so what you want to make sure, one, is test your, let's start with sensitivities first, right? Sensitivities testing just means looking at the assumptions you made, looking at the one that you were set for each of those. For example, for the number of sales per month, you might have set an assumption that you will sell 20 items of whatever it is each of the next 12 months. That's an assumption, an explicit assumption. So ask yourself in the question is, what happens if you sell half of that volume of goods? What happens to your profit? So take that, input it, and see what happens to your profit number. So do all the workings, come up with the number. You might see that your profits drop, but maybe not by a half, but maybe by more than half, maybe by less than that. So that's sensitivity testing. Test your profits against this assumption of business volumes. Does it change much with business volumes? And that's definitely an assumption that would change things a lot. Because volumes drive profits, volumes of new business especially. So test it against. And in the scenario of people that have more recurring business, what happens if you lose business a lot, in that first month or two? Instead of gaining new customers, you lose the current base, you have the retainer base. what happens? So test your the sensitivity of your profit number to changes in your assumption, and find what changes it the most. What is it really sensitive to? Because that is the one thing you must have a clear plan of attacking, or rather not attacking, um, but for tackling that that issue. If you don't have a solid plan for tackling that, if it happens, then you will be your profits will be compromised, and your whole valuation would in fact your business would be overvalued if you have potentially if you haven't thought about the sensitivities. So look at the how sensitive your model is around certain assumptions, and the ones where it's most sensitive to, earmark those, come up with strategies to mitigate any risk there that will result in your company making a loss, or even a horrible loss at the end of the day. So and in the example of COVID-19, really, the big thing that most businesses might not have tested a sensitivity to is loss of business, right? You closed almost, there was lockdown, you had to close immediately. And, and, um, and some businesses had no customer the next day. Did they ever test that scenario that if they don't have any customers coming in, can they still meet their short-term cash flows from their reserves? So some customers, some small business owners hadn't tested that assumption in their forecast if they did it. And so be ruthless with this exercise of testing your assumptions against their sensitivities, and find and even in that worst case scenario, how much rope do you have to survive or to even make it in your business if if that pans out as your reality. So find those key risks by doing sensitivity testing, those risky assumptions, and then come up with a plan of action. And then scenario test analysis is really similar, but look at how the things that you're sensitive to the most, what your business is sensitive to the most, how if they work together, if they happen at the same time, and then you end up in a certain scenario, what the impact is. Don't just look at one sensitivity, right? Volumes of business, or your customers lapsing, or your price being lower than expected. Look at all of them happening at the same time. What happens if you lose 10% of your customers today and you have to reduce your price because of COVID-19 impact? And let's say, and your electricity bill shoots up because of price increases by ESCOM. What happens in that scenario? So even name scenarios, we've seen people even naming scenarios where they imagine kind of the worst case scenario, not just being because of one particular thing, but really a combination of things that are working against their business. And they then set up plans, or at least action plans around what they might do in those scenarios. And so maybe you find the scenarios you're most sensitive to, and without even going to the worst case scenario, there might be at least 3 or 4 scenarios you can map out that can, where things, if things work in combination against the company, things can be very bleak for the company. So at least you want to have tested that in your forecast and say that even in this scenario, my company can still, make a certain amount of profit per year. Or at least it can, these are the plans we expect to implement to recover from that scenario, or to be able to meet a certain at least minimum performance. And so that's the power of scenario planning and sensitivity testing. It's very difficult to speak to without illustrating, and so I think a good exercise for anyone interested post it is to throw out some questions around scenarios they are facing that we can actually chat about post this, see how they can better plan for those scenarios planning out in their business, to really have a robust set of future forecasted results. But you're doing this whole forecast because you're actually hoping that that will be the actual performance of your business, or better yet, that your performance of your business will be better than what you forecasted, not worse. And so to make sure that it's not worse than that, do the sensitivity testing, do the scenario planning, and then set preventative measures where you can, or at least line up a plan of action, whether it's borrowing debt, or swapping out cash flows, or managing your customer performance, or whatever it is, to try to set yourself up for at least a plan of action in the scenario that there are things that happen that you hadn't accounted for. And I think the exercise then is to say, what red flags can I set? How do I know that I'm going into the scenario, that I'm moving along towards the scenario that I don't want to move into, or that really that assumption that we've spoken about, it can't be as worse than a certain amount of threshold or intensity for otherwise the company will be going to complete ruin. So it sounds arbitrary, but think about those things and say, how do you set plans to prevent those? And I think that's really delving into that's really covers these 3 points here: forecasting, valuing a business, and scenario and sensitivity testing. They really cover this whole exercise of financial planning, if I put it broadly, for a small business. It applies similarly to any other entity or individual, but it's to really look at it from this high level outlook and not really zone in on the numbers at this stage, right? But it boils down to assumptions more than anything, and I hope I would have captured that in the session. So I think if I try to now see if there's any questions.
Hi, Sivenathi. We run out of time, and so we have I'm sure we'll have questions. So again, Sive is from SM Tax, and you're welcome to send them an email. I'm not sure, Madam CFO, are you going to offer an incentive for those who follow up? Are you offering any discounts?
Yeah, so if you're from this session, I'm definitely offering let's say discounts, but I'm offering to at least just look at your case and see how we can push you forward without investing too much effort and time. And I think sometimes if you put numbers into it, it can add up. So happy to discuss any kind of discounts if anyone's interested, but it's to really engage you further on any questions if anyone does have those.
Brilliant. Thank you so much for your time. You can find Sivenathi and SM Tax and smtax.co.za. They offer both accounting, bookkeeping, and finance services, as you can see, and tax as well. So do reach out to Sivenathi. Info at smtax.co.za, or go to their website where you can find all the information you need to reach Sivenathi and a team over at SM Tax so that you can continue the conversation to business. I do apologize, everybody, that we are running out of time. So if you had questions, you're going to have to direct your questions directly through to Sivenathi so that she can answer your questions. Thanks once again, Sivenathi, for your time. I mean, SM Tax is also hosting a workshop next week. So details of that will follow if you follow the BWA Women's Month, hashtag BWA Women's Month, or follow on our website, womensmonth.co.za. For everybody who's looking forward for this lunch session, thank you so much for having joined us. We're going to play a quick video over the lunch, which is going to just take things back to when Putti joined us last week and hear her input into the sessions. And if you're wondering what's coming up next, we've got effective use of technology in training and coaching from Claire Shuttleworth, and that will kick off at the top of the hour at 3 o'clock. So do join us again back at 3 o'clock, where Claire will be talking about that. If you want to join Claire's session, the web inner details are listed right there on the right-hand side of the stream. So with the access code BWAWomen. So at the top of the hour at 3 o'clock, you're welcome to come in and join Claire Shuttleworth as she delivers that particular session. But with thank you again, Sivenathi, and we're going to now go over to the new session. If you allow me technically just to play this. Thank you so much, Sive.
Of South Africa for that site, absolutely loud and clear. I think one of the things that really do come to mind is one who is an entrepreneur and has been for about 10 years or so, still a young person, is the value in finding really great networks and other women and working together for a common cause. And I think this also just takes me back to that march in 1956 again, as a young woman, to say, how can I also be intentional in finding women who do share a common goal. How do I work, with more women? But again, as well, how do I open doors with other young women or younger women than myself? So I'm not going to waste any more time. I am going to introduce our incredible speaker today. I'm going to read her bio. She obviously has a very long and illustrious biography, and she has so many achievements within the business or within her career. So I'm just going to go ahead and read this. I'm absolutely excited, as many of you that are joining here today. So as we already know, her name is Phuthi Mahanyele-Dabengwa, who joined Naspers as CEO, Naspers South Africa, in July 2019. Now, before she joined Naspers, she was the co-founder and chairperson of Sigma Capital, which is an investment holding company that was formed in the year 2015. Now, before Sigma, Phuthi held a position of CEO with Shanduka Group, an investment holding company which she joined in the year 2004 and left in 2015, where then she would co-found Sigma Capital. And prior to that, she was the head of project finance at the DBSA, which is known as the Development Bank of Southern Africa. Earlier in her career, she spent a few years in New York at Fieldstone, an international firm that specializes in the financing of infrastructure assets. She later then transferred to the South African office, leaving as vice president. Now, of course, these are huge achievements, and she has put so much effort in getting where she is today. But one thing that Phuthi might not remember is that a few years ago, I think it was 2014, 2015, is that I did get an opportunity to meet her as a global shaper, and she falls under the YGL program of the World Economic Forum, which stands for the Young Global Leaders. And she was giving back at the time as the CEO of Shanduka Group to a particular school in Soweto, and I got to meet the person, Phuthi. And so I can attest today that outside of this long and illustrious list of achievements that she has attained over the years, she's also an absolutely incredible person and very warm. So without any further ado, Phuthi Mahanyele-Dabengwa, over to you.
Thank you so much for that introduction, Cindy. That's very kind of you. Good evening and welcome to everyone. I trust you're all keeping safe and that those who are affected by COVID-19 are. We look pointedly at ourselves as women and the roles that we play more of in our families, as well as in broader society. It should be no surprise to any of you that Michelle Obama is a huge source of inspiration for me. I'd like to quote from her. She says, "All of us are driven by a simple belief that the world as it is just won't do. That we have an obligation to fight for the world as it should be." And yes, we do have to fight for it. All of us have had what Michelle Obama called that first flare of outrage. That moment when you realize that as a woman, you were seen at best as a second-class citizen. At worst, you were dismissed as inferior and unequal to the task, whatever that task may be. It happens to all of us all the time. When a new project comes up, we are overlooked. When a meeting is called, our views are ignored. Our talk is interrupted, all because of our gender, not because of what we have not achieved, or at least not because of what we have achieved, and not because of what we know or have experienced, but all because of our gender. Then, to make it even more difficult for us, you throw in race. This is our legacy. But our legacy is also one of triumph. Our legacy is one of success as well. All around us, we can see that in spite of all the negative issues that we deal with. All of us here are evidence and witness of that success. I know this sounds simplistic, but I'm here due primarily to one thing: education. My parents, and mostly my father, as my mother died at a young age, were determined that their daughters would have their own place at the table, that their daughters would have a voice, and that their voices would be heard. Of course, as a young girl, I never pictured myself in a corporate boardroom talking to my peers and colleagues. I saw myself on a stage dancing. I wanted to be a ballerina. ballet seemed for me to be moments of perfection, captured in a movement, poise, and balance. Clearly, some of those early dance lessons and appreciation for the art have stuck with me because I believe most of what we do, most of life itself, is about movement, poise, and balance. And that one thing, education. From my father's love of learning, I witnessed firsthand the power of knowledge. My father raised his two daughters alone as my mother had passed away at the age of 42. He worked firstly as a mechanic at Volkswagen. And one day he saw that the company was offering scholarships. He applied and ended up doing a Bachelor of Economics at the London School of Economics. He went on to do an MBA at De Montfort University in the UK and finally obtained his doctorate. Then he went into business and became very successful. He is my inspiration. And he is the reason I went on to do further the degrees that I did at Rutgers. Of course, he decided I should go to Rutgers and then at De Montfort for my MBA. Essentially, I did the exact same degrees as he did because that's what he decided. And I did what my dad told me. There have been many lessons gained from my father and in the early years of my career, which provided a strong basis for the trajectory that I've had. People often ask, what drives me? It's a complex question with no complete answer. But I've always had a hunger to grow, to do more. So when I was in my 20s working a steady job, I knew that if I wanted this to happen, I would need to do something different. And so I decided that I would go and work overseas in a top-tier investment bank. And I had an opportunity to make an application for an internship at Fieldstone, a New York investment banking firm, working with structured products to help develop emerging economies. Anyway, when I submitted my first application, it was rejected, not just once, but twice. The third time, they had to accept because I kept on submitting this application. Anyway, it was a tough environment, very formal, corporate, with lots of written and unwritten rules. Junior professionals didn't wear colors. The uniform was such that we were to wear black or navy or gray. I learned that unwritten rule very quickly. The real issue was getting access to work to be able to prove that I could do this. I had to learn on my feet and put aside my shyness. I'm naturally a very shy person, and to go and introduce myself to people and get involved with things that weren't going to come my way unless I moved forward was not an easy task. But as we know, perseverance is key. I learned quickly that work or being successful at work wasn't just about your skill in doing what you do. It was also about your ability to move toward and engage with those people working in your environment. So picture me. I'm a very young Black female intern back then, the only Black intern. I'm from South Africa, and I'm among a group of Ivy League graduates in a high-level corporate environment. And all of them were American, with the exception of me. I doubt anyone had even heard of my university that I came from, and I assumed that they were judging me based on this. It was one of those moments when you start having negative thoughts about your abilities and begin to doubt yourself for no good reason. It's a default thought pattern for many of us as women. But then I realized that it wasn't personal. These people, these were people who wanted a job done. They had to have the confidence that whoever got the assignment would be able to deliver. Whether they liked me or not was irrelevant. And I knew I only had 6 months to make an impression to get a job at the end of it. I wasn't going to get an assignment by allowing my insecurities to get the better of me. So it was time for me to move. I decided that I'd go around and introduce myself to the partners. And of course, not everything went according to plan. You will learn to never assume that because someone is the same gender or race as you, that they will necessarily treat you the same. But I stuck to it. My break came from a white male mentor at Fieldstone. His name was Andrew Cavitman, and he decided to assign me work. I was meticulous in preparing that first report, checking and rechecking it. I was, to go back to the ballet analogy, poised. And it worked. By the end of that internship, I was offered a job and worked my way up to becoming one of the vice presidents in the company. This story for me is important because in discussions about gender equality, we should interrogate our own thinking and our own stereotyping. Sometimes support comes from the most unlikely places. And if you are willing to grasp that opportunity and to run with it, great things can happen. This is what happens when people take the time to work with you and engage with you in a meaningful manner. It's important that we recognize the more tangible, intangible aspects that come with a senior position that can help more junior women in our organizations to chart successful careers. As senior women leaders, we're able to open doors. We're able to assign work. We're able to help them to network. We need to bear this in mind and take it on as a personal mission. Today, more women are graduating from universities than men in South Africa. Yet, what do we see when we look around our boardrooms? It seems that less than 5% of women have made it to the top. Where have all those ambitious and intelligent women gone? The gender gap needs to close for many reasons. And we have a duty to never forget that we are here to make sure that those ambitious, smart women are recognized and that they are given their place at the table and that they believe and act as though they deserve it. The opportunities I had as a young professional, which were given to me, were because the people who were empowered thought and behaved differently. They were willing to engage with me. It is why I think it is so important that we pay it forward. It is part of the balance we strive to achieve. I learned from engaging with that experience and not shying away from it. It was a difficult decision to not stay in New York, but I realized that it was time for me, as in those days, it was the 90s back then and the early 2000s. And there was a lot of opportunities in South Africa in terms of BEE transactions that were being done. So in terms of corporate finance and private equity, there was a number of opportunities for a professional like myself. So I really wanted to come back and work in South Africa. And so I came back and I worked briefly with the DBSA, but I realized that the DBSA, as respectable a place as it is, it was not the place for me. And out of the blue, I received a phone call from a friend. His name was Rowan Smith, and he wanted me to meet with the chairman of a company called MCI, Millennium Consolidated Investments, which then became what became to be known as Shanduka. I told him I wasn't looking for a job. So he told me, look, just hold on. And he handed over the phone to that chairman. And he, so we talked. I talked to the chairman, who turned out to be Cyril Ramaphosa. And he invited me to come and meet with him. I went, and within just a few minutes, I realized that this was for me. I couldn't explain it at the time, but it was what I wanted. And I think it's a lesson in just knowing that sometimes you need to trust your intuition. It might not make sense. I mean, in this case, I was in a situation where I was going to say no to an established, financial institution, and I was saying yes to a brand new organization whose future was uncertain. But my intuition was telling me that's where I needed to be. Anyway, I called my friend Rowan, and I told him that I didn't know what job they wanted me to do exactly, or what salary they wanted to pay, but I wanted to come and work for Shanduka. I was back in motion, and it felt great. And so it really is important for us to trust our own intuition sometimes. I think what I learned was also to be open to all eventualities. I spent 11 good years at Shanduka, and then because life is not always what we plan, I had a stroke. It took me some time to recover from that stroke. And when a catastrophe of this size hits you, you need to dig in deep, and you need to trust those who are close to you. I thought everything was just as before, but I was the only one who could not see how bad it was. My family was amazing. Slowly, balance came back into my life. And then I was approached by R&B in terms of the fund that we started for Sigma Capital. And then, of course, I was approached by Naspers. Again, at that time, when Naspers approached me, I wasn't looking for a job because I was very comfortable running my fund and, working, it was a very comfortable environment. So I wasn't really keen to go back into a corporate setting. But I agreed to meet with the group CEO of Naspers at Amsterdam. And so here I am today. It was a quick decision, but it was the right one for me. And so what have been the enduring lessons throughout my journey? I think I've always been open to the possibility that your life can change. And so that is something that is important. I was also always very much aware of the circumstances that my parents had grown up in. But my parents had instilled in us that ability to dream, to believe that we could change our lives, that it could be better, that there could be more. And I still believe that. I'm a very spiritual person, and I take time for introspection and to reflect what is around me and what is happening daily. I believe we should always dream. We should always work towards changing things for the better. And it doesn't have to be something that is that big for everyone, but for you, it will be something that is big. And so, I believe in dreaming and striving towards more and better. We all have that power within us, whether you are physically blind or physically able or not able, we all have that ability within us. As long as we have life and we are living, we have that power within us to dream. My life does work out, but life does work out differently sometimes for some of us. And so things don't always work out as expected. And I know I'm one of the fortunate few. And that is why it's so important for us as Black career women to always remember to speak to younger people, to be on stage to show them that where you have succeeded, they can too, and they can even do better than you. And that by being a role model, we can give them that hope that it is possible because we've all started somewhere. This approach is partly responsible for us at Naspers having set up an entity called Naspers Labs, which is the company's South African social impact project. Naspers Labs are all situated. These are all labs which are computerized, so all young people coming into them, and we have unemployed youngsters at the ages of 17, 20 to 25 coming into the labs. And we've got them all, in different parts of the country. And they come in, attend the labs to learn how to become economically active. And everything is done on the computer. And so the young people are forced to learn how to use computers because everything, all communication is on those computers. And so they are trained to either become, to unlock their potential of being participants in the township economies, either as employees or as micro-entrepreneurs. The vision is to equip them with personal confidence and necessary skills to help them to find jobs and to start an enterprise, as this is something that is so important. More than 2,000 youngsters have been through the labs, of which, and of this 2,000, 60% of them have found viable jobs. The labs have only been running for just a year, and so it's a brand new entity for us. And we hope to do more. There's a lot of work that's going into it now. These youngsters will themselves become role models in the future, and that is what we're working towards. But if we are to make significant socioeconomic changes, then we need to think beyond that. Underlying all empowerment is economic growth. We're using technology to develop engines of economic growth. A prosperous country can offer opportunities for women and young people to contribute to society in more meaningful ways. Naspers is one of the top 10 consumer internet companies in the world. We own or build leading technology companies addressing, or you could say engaging, with people's everyday needs. In many ways, digital transformation is part of this engagement process, and this is significant for the empowerment of women. Digital transformation can help women to overcome many barriers. For example, e-learning platforms enable remote learning and provide access to knowledge previously denied to them. Finance and banking applications that help women to manage their own finances independently. The fourth industrial revolution is a key factor in closing the gender gap over the coming decades. And the gender gap is real. We all know that. We've all experienced it, and we must all challenge it.
Thank you so much, Tiputi. Again, you can catch that video on BWA Gauteng's YouTube page. It's still up there. We will continue to promote the page, but we have come to that time where we have to continue our session, and we're going to have to hand over to our next panelist, Claire Shuttleworth.